for reaction to yesterday's hearing. We are joined by Jay Clayton, former SEC chairman, CNBC contributor as of yesterday, Apollo's lead independent director. And I want to ask you about that in just a moment, Jay. But let's start with this hearing. And we're going to have Ken Griffin on a little bit later. So I'd love to get your thoughts on this issue of payment for order flow, which seemed to be so central to this hearing and to these issues that are being brought to bear. Do you think payment for order flow is a good thing or a bad thing?
Well, Joe will laugh at my first two answers. So first one is happy birthday. And then the second one is, it's more complicated than that, right? Why is payment for order flow part of the system here, and why has it been allowed? And look, what we're trying to do is drive competition, transparency, and resiliency in this system. And one way to drive competition that the SEC has looked at and should continue to look at. And I thought this was a terrific hearing because it brought to bear a lot of these issues. It is through payment for order flow. And at the end of the day, does that practice drive better execution, lower overall cost for the retail investor is a good question. The answer has been that we think so. But as the ecosystem changes, and I think you're going to ask Ken this, what do we do to continue to increase competition, to put the exchanges on a better foot? We have to look at this practice as well. And I expect the SEC will do it, and I expect that Congress will continue to ask them to do it.
Jay, you said just now that you think that there is better pricing. I don't know if it's the prevailing wisdom, but the narrative is that because retail investors aren't paying commissions, they're paying in another way through payment for order flow, and therefore are getting worse execution. Do you think that's right or wrong?
Well, let's start with the premise that liquidity is not free. Okay, to trade, there has to be some kind of payment. It's not free, and it's not free for lots of reasons, including we have to build up an entire ecosystem that is resilient. One of the things that was focused on at yesterday's hearing is how resilient is the system? Are there systemic risks, et cetera? You have to have a resilient system that costs money. Liquidity isn't free. People take risks to provide liquidity. So there is some cost. The question is, how are we measuring that cost and where it gets paid? And are people aware of the cost that they are paying? They should be. They should be aware of the cost they're paying. They should be aware of how much payment for order flow may actually change their execution, if at all. Now, how we measure it today, and this came out in the hearing, how we measure it today is against, the term price improvement came out. And price improvement is how much better did you do than either the end of the bid-ask spread. And we measure that against that bid-ask spread. And that is published. I'm being a little bit technical here, but that is published on the lit exchanges for 100 share lots. There's a lot that we should look at as to whether that is the right yardstick for measuring price improvement and best execution, including whether we continue to have 100 share lots or we go to smaller lots for higher price stocks. Now, I've just said a lot there, Andrew, but all of that came out during yesterday's hearing, and I expect Joe Muglia and Ken to comment on that and the types of improvements that we should be making to improve competition while maintaining resilience in the market.
Hey, Jay, it's Joe, and please do not give me just a yes or no answer. I want to hear what you really think in terms of nuances. So don't limit it to just yes or no. Last time you were on, we were sort of still in the middle of the frenzy, and we used the term pump and dump and just raised the. We used it just to say, is this similar? Is it akin? Is it a pump and dump 2.0? Is it a pump and dump with a social media component? Now we can look at a chart of GameStop, and you've seen it. I mean, does this, in your view, represent a modern day pump and dump using social media?
Wow, you know what? I will give you a yes or no answer. The quick answer to that is no. I don't think so. based on what I've seen. I think the SEC is going to take a look at it. Whether there was any kind of coordinated behavior to manipulate or not, they will be looking at that. But as you look at that, the overall participation in this, it was fairly transparent what was going on here, Joe. And I think you saw that in yesterday's hearing. And actually, I must admit to being entertained by Mr. Kitty. You saw that people were very transparent about what they were doing and why they were doing it, which was fairly interesting.
You get on a chat room and you pick a stock and you get all of your friends all to act on it at the same time. And how is that different than what we would have seen with an iOmega or a Press Tech or any of the names from the past, or things that we saw Stratton Oakmont try to do from time? I don't see how it's different, Jay.
Well, look, I think in the abstract, you make a good argument that it's not different, and that a group of people decide that they like this, but whether they got all together and did it like the Stratton Oakmont did, knowing that knowing the end game here, I don't think so. I thought there was a great comment yesterday about markets being self-correcting, and let's not lose sight of the fact that there were retail investors here who lost money, and they lost a lot of money. When you see something like this, you should not be participating in it, as a retail investor, unless you're understand the risks that you're taking and are able to lose the money that you're putting in. And in particular, Joe, I just want to point out, I thought something very good about yesterday that you were talking about was options and margin, and what type of qualifications that you need to buy stock on margin and to use options to effectively use leverage in your portfolio. You just hate to see that for any kind of retail investor that doesn't understand those risks.
Shepard Smith here. Thanks for watching CNBC on YouTube.